morning again. The next presentation is from Centerra Gold, and Paul Tomory, the President and CEO, is going to be presenting today. We're going to go a little bit retro. We're going to do a socially distanced fireside chat, I believe. It's sort of the proposed thing here. So I'm going to lead off with a couple of questions, and Paul's going to work them through with the presentation there as well. So the first question we have here is, in the first half of 2025, Centerra focused on advancing a pipeline of organic gold growth opportunities in North America. Can you outline the key projects in that pipeline and how they contribute to your near and long-term growth profile?
Yeah, thank you, Brian. I'll do a quick recap on the portfolio and where we've come over the last 3 years. I mean, some people still associate Centerra with Kyrgyzstan and the Tomory mine, but that's old history. 3 years ago, Centerra had one operating asset in Mount Milligan. Öksüt in Turkey was shut down. Thompson Creek, Kemess, and Dako were on care and maintenance. And there's a lot of questions around the portfolio. Were these viable? Were these assets that had a future? So we spent about a year and a half through 23 and 24 coming up with an assessment of what each asset had as its potential. All of them still have a lot of metal in the ground. We've put out now studies, and I'm going to touch on this, on each one of them. Mount Milligan, we have a view on Kemess, Goldfield, Thompson Creek, and the Molybdenum business. And what we have now is we're moving to execution. So what we have in the portfolio is Mount Milligan, our cornerstone asset. We just put out a PFS that outlines a mine life of 20 years. And I'll talk a little bit more about it in a few minutes, but it's going to be a lot more than 20 years. We have the Öksüt mine in Turkey, which has mine life till 2030, with some residual leaching after that. And we've just greenlit the Goldfield project in Nevada, which will provide another continuity of 80 to 100,000 ounces a year through the mid-2030s. We are also working on a PEA to reopen the Kemess mine, very large copper-gold porphyry north of Mount Milligan, and we're targeting a 15 to 20-year mine life. Again, I'll touch on that. But Brian, that's what we've been working on, is coming up with a technical concept for each of our major assets and then daylighting a path forward and now starting that execution.
So maybe digging more into the nitty-gritty here, you recently published the PFS that you mentioned at Mount Milligan. Just can you give us the highlights and the results that you've got there? And then going forward, now that you've got this line drawn in the sand, what exploration and opportunity activities are going on, and what should we expect to be the cadence of news releases going forwards at Mount Milligan?
Mount Milligan, as I said, is our cornerstone asset. Very large system, copper-gold porphyry. And this PFS outlines a mine life until 2045. And that's just a point in time. The PFS takes all the measured material and converts it, measured and indicated, converts it to reserve. There's an awful lot of mineralization and inferred material beyond that. But in any case, this PFS does three things. Extends the mine life first and foremost. We also increase throughput. We're making some upgrades to the process plant in the ball mills. So you're going to see a 10% throughput expansion in 2029. And then the third key element was the design and the early view on where to put incremental tailings. The main reason we were actually capped at a 2036 mine life beforehand, physically at least, was on tailings capacity limitations. So what this PFS does is it identifies a second tailings facility. And by the way, we have sized that tailings facility to accommodate material until 2070. So this slide here shows the production profile, and you can see it's a pretty steady production profile, 150 to 170,000 ounces a year of gold, 55 to 65, maybe a couple of years higher than that on the copper side, and as I said, going out well to 20 years. It's a low capex project, 186 million. Most of that is associated with the tailings facility, and that spend doesn't actually happen until the early 2030s. There's some capex going into the process plant upgrade in the near term, but most of the capex is deferred. This slide, though, is perhaps the most exciting thing about Mount Milligan. A little bit hard to see, but you can see there's a number of pit shells on the slide. The first one, starting from to the right there, is the current surface. The next one is the previous reserve life, and then you can see the 2025 reserve pit, which is the one we just put out here. The important point is you can see the extent of mineralization to the west, to the southwest. It just keeps going. We've done some early exploration drilling, going out quite a distance, a couple kilometers from the main deposit, and we are very confident that this mine will operate into the 2050s and even the 2060s when you look at the extent of the mineralization here. The last point I'll say is we have Royal Gold as a partner here. We had an amended cost support agreement that we agreed to with Royal Gold about a year and a half ago, and that enabled this mine life extension because it gave the incentive for Centerra and Royal Gold to participate on what is really a world-class asset in British Columbia. Last comment I'll make here on Mount Milligan. British Columbia, and this applies to Kemess as well, British Columbia has, over the last year, instituted very mining-friendly policies. They have prioritized certain projects as critical to the economy of British Columbia, and I'm happy to say that Mount Milligan was one of those projects selected for expedited permitting, and so we are in the midst of permitting some of the elements of the project that I've just described here. So we have very good relationships with the province, with our local First Nations, and that goodwill extends to Kemess, and the province and the nations are looking forward to what we might put out on Kemess with our PEA. So that's Mount Milligan.
And in Q2, you did lower your production guidance at Mount Milligan and increased your all-in sustaining cost guidance for Centerra overall. Can you maybe just go on with what's happening in 2025 with production and costs at Mount Milligan and at Öksüt?
Yeah, so Mount Milligan, we've had 3 poor quarters. The production hasn't been where we wanted to do, and one of the things we needed to do with this PFS is to reset the perspective on Mount Milligan. Principally, what has been impacting us over the last 3 quarters is we have been mining in high-grade zones where the grade hasn't quite materialized to what the previous model had predicted. With this PFS, it represents the culmination of a very extensive infill drilling program, which we are now complementing with an RC grade control program that gives us a lot more confidence on the grade. So this PFS represents the new resource model, which has reduced the grades in some of these high-grade zones. In effect, we weren't drilled to tight enough spacing because the high grade is more contained in narrower structures, and the previous model had overestimated the extent to which the high grade impacted zones near it. So we've done a much tighter program. And I'm also very happy to say that against this new model, we are reconciling very well. This new model we've had in place roughly since December, but with some incorporations in the first half of the year. And when we put out this PFS, it is against that model with which we are reconciling well. You also asked about AISC revisions. At Mount Milligan, simply a denominator impact, fewer ounces, less copper, higher unit costs. In the case of Turkey, we revised AISC upward. It's really a good news story because gold prices are much higher, therefore the royalty costs are higher, so we're paying a higher proportion on the royalty. And to a lesser extent, Turkey readjusted higher some of the top-end gold price-related royalties, but principally it's because gold price is higher and we are paying more in royalty, which is a good place to be.
And you also, as you mentioned earlier, made the decision to move forward with the Goldfield project. What were some of the key factors that led you to greenlight the project, and is there a chance for increased mine life beyond the initial 7 years contemplated there?
Goldfield is an oxide resource in Nevada, 700,000 ounces. Perhaps it's not to the scale that we would initially have liked, but what we did is we did a comprehensive technical relook at recoveries. Is it better to run-of-mine heap leach, whether versus crushing? And what we've come up with is an optimal blend of crushed material, run-of-mine material, to drive recoveries close to 10% higher than what we had previously conceived. And of course, the higher gold price is certainly a contributing factor here, and we put in advantageous collars for 50% of the production in the first 2 years, approximately 20% of the total production. Dave Hendricks and I, our new Chief Operating Officer, we've got a lot of experience with Nevada heap leaches, and we view this as a straight down over the plate type of Nevada oxide heap leach, and we're happy to be proceeding with it. You asked about exploration potential. It's a large land package. We have drilled it. It has disappointed to some degree on exploration potential, but we haven't given up, and we're going to see what we come up on the land package. There are also sulfides there, transition materials that we haven't incorporated into the study. With the gold price where it is, there may be opportunity for some of that sulfide to mobilize into a mine plan down the road.
And as you mentioned a little bit earlier this year, you announced that you'd be working towards a PEA at Kemess. Can you give us an update on the scope and how that study is progressing and what the timelines would look like going forwards?
Yeah, Kemess is another one of these assets that were in the portfolio that had lain fallow. There wasn't really a good, compelling story there. But let me just do a bit of a reset on what Kemess is. It's a past producer, very significant size process plant, 45 to 50,000 tons a day, operated for about 20 years, was very profitable, and it was shut down in an era of very low copper prices. On this slide, you can see some of the infrastructure in place. A very significant, large concentrator, crushers, conveyance, a camp, an airstrip, but perhaps most importantly, a power line. We own a 300-kilometer plus power line, which in today's environment would cost at least $1 billion to replace. We are also the key to the Toodoggone district, which is a highly prospective district. Many juniors are active north of us, and we are actually literally the keystone to the Toodoggone. The people access that district through our airstrip. They use our camp. They use our facilities. You can see the size of the mill, the size of the process plant, the water treatment plant. The mill does require upgrades. One of the lines is gone, and the camp needs extensive refurbishment. Now, if we go to the next slide, which shows the mineralization, Centerra, 3-4 years ago, had a concept to develop a deep block cave project. We don't think there's enough metal at sufficient grade to justify the development capex, the development timelines, and the risk relative to the size of Centerra. So we abandoned the block cave concept. But over the course of the last year, we did a comprehensive review of drill inventory and built a new resource model and discovered or recognized that there's a very significant deposit with almost no strip that is open pittable. We're also able, we think, to access some of the high grade through more conventional underground methods. So we are now carrying out a PEA to see whether or not we can come up with a plan to reopen Kemess. What we are targeting is a Mount Milligan-sized operation. The grade is a little bit higher, but the throughput's a little bit lower, so it roughly gets the same scale as Mount Milligan. And certainly the capital development, the capital cost here would be a fraction of what a greenfield would be in this setting. I think you'd all appreciate that a 40, 50, 60,000 ton a day greenfield concentrator on a big porphyry deposit in northern British Columbia, you're looking at $4 billion minimum of capital spend. We're targeting a fraction of that. We're targeting 20% as a rough ranging shot on that. We still have to do the work on the PEA. It'll be plus minus that range. And the capex will go into refurbishing the plant, refurbishing the infrastructure, but also developing new infrastructure. This deposit that we've outlined is approximately 10 kilometers away over a ridge. And what we're proposing to do is drive a heading and have some underground crushers, underground conveyors to bring the material over to the process plant. So we're very excited about what we've got here. As I said, we're targeting a Milligan scale operation, 250,000 ounces of gold equivalent a year. We're targeting a starter mine life of 15 years, but like Mount Milligan, the exploration potential is very significant. And just to reiterate, the resource that we're looking at here doesn't even take into account a lot of that deep material that we've currently shelved for now, and that may mobilize in the future. So if I go back to the slide that I showed at the beginning with the production profile, what Centerra has with Mount Milligan, with Goldfield, and with Kemess is a perspective on growing organically to be a 650 to 700,000 ounce a year producer, which importantly we can totally fund with existing resources. So that's the highlight on Kemess, Brian.
And we'll switch from the copper and gold world into more of the moly world here. How are construction activities progressing at Thompson Creek? Are you still on track for first production in 27? You also previously mentioned that you continue to evaluate strategic options for the MBU, and how is that process going?
So the overall project is going well. Just a quick reminder, about a year and a bit ago, we greenlit the project, $400 million of capital spend, principally around stripping, but also, like Kemess, an extensive mill refurbishment. The stripping activities are well underway, and we remain on schedule to encounter first ore in the middle of 2027. For those of you not familiar with it, we have the Thompson Creek asset in Idaho, and we also have the roaster, one of only 3 in the U.S., in Pittsburgh, which has operated on limited capacity over the last number of years on third-party material. But the business case here is to ship very clean concentrates from Thompson Creek to our roaster in Pittsburgh to deliver into the U.S. market. This is a very exciting space right now. I know we're at a gold conference, and here I am talking about molybdenum, but we're very excited about this metal. The current environment in the United States is very conducive to a metal which is fundamentally in the steel supply chain in the United States. Molybdenum prices have traded up significantly since we greenlit this project, and we continue to believe that the fundamentals for molybdenum remain very constructive. At the time of the announcement, you can see the number there, $472 million NPV. That was a $20 moly. If you account for the capex we've put into it and you apply spot moly, this business is worth $1 billion. That leads me into the second part of your question on the strategic process. We recognize that molybdenum is potentially an odd fit. Certainly it's perceived to be an odd fit within the business, but we like the business. This is a very valuable business that has the ability to generate significant cash flow. We are open to transact on it, but we want to make sure we deliver a good portion of the value to our shareholders. And ultimately, it may be spinnable or IPOable on the eve of cash flow. But I think the important part is this is a robust business, and it has the potential to deliver very significant value to our shareholders. But we are open to an outcome strategically.
And we've spent a fair bit of time today talking about growth. The next question that usually comes is, how are you going to finance that?
This is maybe what sets us apart. You know, we talk a lot about our valuation discount. We're frustrated with where we trade. There's a number of reasons why we trade low. One is maybe the perceptions around molybdenum. Another one is that unlike some other of our gold peers, we don't have the immediate free cash flow leverage, meaning we have development lag, though we do have free cash flow from Milligan and Oxu, which is significant. But on the development lag point, on the point of our projects, we can fully fund quite easily everything I've described here. The incremental expansions at Mount Milligan, the build out at Thompson Creek, the build out at Goldfield, and ultimately the build out at Kemess. We can quite easily afford all of that very comfortably while continuing to pay our dividend and while continuing to pursue a very aggressive buyback. In the last 2 years, we have bought back 10% of our shares, and we will continue an aggressive buyback while building out this project portfolio that sees us ramping up to 650 to 700,000 ounces a year of gold equivalent in the next 5 years. So that, and you're probably going to ask about M&A. We don't need to do M&A. We're not going to do M&A. We have enough metal in the ground to be able to put forward a compelling story. And one of the things we talk about on valuation, we have a slide that compares us to some of our peers on some valuation metrics. So, for example, the amount of metal in the ground. So this slide shows what we think is a deeply discounted valuation, but more importantly, on some key metrics around metal in the ground. Look over on the right, EV per global resource. We're off the charts at the bottom there. This is metal in the ground against which we have, and we are advancing projects, essentially which are brownfields, to reopen. The other two are also interesting. We have a very, relatively speaking, on an absolute basis, a good resource base, and a lot of that is in very safe jurisdictions, BC and Nevada principally. So to answer your question, we're fully funded and very comfortably, which will allow us to continue to drive the buyback and pay the dividend.
And maybe in the final minute or so that we have here, I know you've gone through quite a few of them, but if you could just summarize the catalysts we should be looking for over the next 12 to 18 months.
So continued execution, delivery at our operating projects, but in the project space, we're going to be putting out a PEA, as I said, on Kemess. That'll be in December, January. We're going to be talking about that at the next major conference. And then in terms of Milligan, we're going to be starting to execute on the ball mill upgrades to get the throughput expanded, and a lot of ongoing permitting work at both Milligan and Kemess. So look for major milestones on project development, and then ultimately bringing the throughput up at Milligan and putting Goldfield into production.
We do have about 1 minute remaining. Question over here, just wait for the microphone to come over.
It appears to be a very exciting portfolio, particularly Mount Milligan, where you're able to get projects up and running at quite a nominal startup capital, and they look as though they've got very long mine lives. What I'm trying to understand is what sort of capital you have to spend over the mine lives. How much sustaining capital over that life of mine, for instance?
The sustaining capital is in line with what you'd expect for an open pit, but the initial capital, $186 million, that's spread over the next 10 years. A mine like this runs at $30 to $60 million a year of sustaining capital, depending on when the rebuilds happen and how some certain stripping is categorized. That's the beauty of our portfolio. A lot of metal on the ground, brownfields expansions. I talked about it, Kemess, Thompson Creek, Mount Milligan. The concentrators are there. These are things that are very difficult to build in the current environment.
And that does take us completely to the end of time. Please join me in thanking Paul.
Thank you, Brian.